dip your toe in slowly. I talked to a family office the other day that had lost, they bought $110 million of small businesses over about a 6-year period. And the current audited value of them was under $20 million. And so, if you want to lose $100 million quickly, I think that's a pretty good place to do it. We call that a non-efficient market. I mean, right? Like the definition of efficiency is, if you tried to lose money, could you? And my goodness, you can lose, if you tried to lose money in this area of the market, you can do it very, very easily.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
So, on that note of speaking about finding the right companies, what attributes do you look for? What is Permanent Equity's definition of a successful acquisition for both Permanent Equity, your investors, but also the sellers?
Yeah. I mean, the big thing is we think a lot about how to set the table, right, post-close. Because if you try to get everything you possibly can, it's going to set things up really poorly if you got to work with those people post-close. And almost always we're working with the families post-close. So for us, it's actually a really great feedback loop. And we talk a lot in how we structure deals and in due diligence about setting the table well. So what does that look like? That looks like that everyone got what they expected when they think that they should have gotten it. And that the way that we're operating, what we told them post-close is reality. We tell people, we're like, the CEOs will ask us, okay, what does day 2 look like? Or what does day 1 after acquisition look like? And exactly the same thing you were doing before, just keep doing more of it, and we'll get a call 2 or 3 days after close, almost inevitably every single deal. And they'll say, okay, cut the crap. Now what's the real deal? We say, no, for real, like just keep doing what you're doing. And they'll say, okay, right. But I'm thinking about hiring this new assistant or something. You're paying $35,000 or $38,000 a year. And we're like, I don't know what you're asking us to do. Like, just do what you think is best for the business. Just do it, right? Like, you've been running this business for a long time. Keep running it. I think there's so much distrust, and rightfully so, by the way. I'm not blaming this on sellers by any means. If it sounds like I am, that's not the case at all. I think there's so many horror stories of, people being one type in due diligence, and then, close comes and it's like, all right, now here's the real deal. We just don't play those games. We talk about that all the time. It's like, what you see is what you get. If you like what you see, I think it's going to work out pretty well post-close. If you don't like what you see, well, this is what you're going to get post-close. We give people a lot of autonomy. We trust people until there's a reason not to. And we really, kind of have 2 modes. Either we trust the people we have, or we try to get new people, and that's it. And so, I would say, post-close, it looks very similar. The only exception is that now you've got a bunch of people who care deeply about the business that I think are pretty talented, me being the exception. But now I'm almost functionally useless other than going on podcasts these days. So, that's what we try to do.
I appreciate your sense of humor on that.
No, it's really true.
Well, that's good. You've decentralized to the point of anarchy then. That's the way to go.
Like that. They give me a little ball of yarn and let me go play in the corner.
So you mentioned your due diligence process a little bit. Can you go into more depth on that, about what does that look for? What does that look like on both your side as well as the seller's side? What would you recommend to a seller to do due diligence on Permanent Equity and such?
Yeah, well, so first of all, let's just start with the base assumption that due diligence sucks, no point sugarcoating it. We're going to try to make it suck less, but it's just going to suck. It is dredging up every document that you thought you didn't need, and every financial statement that you'd forgotten about, and it's getting everything together and orderly. And by the way, that's just because, we've got to check a bunch of boxes. We are a fiduciary for our clients. We're held to very high standards, and we have to just make sure we check every box and look at everything. So now when I say everything, I mean that could be a never-ending list. I mean it's the things that we think are, or that we should relatively suspect are important. So what does due diligence look like? It looks like us double checking the things they told us are true, us investigating things that we think might be a problem that maybe they don't even know about. Would be another big category. So we've, look, as odd as this sounds, we found healthcare fraud, we found tax fraud, we found all kinds of stuff. And when I say fraud, is I don't even mean that the owner even knows about it. Oftentimes there's stuff that we're going through and we say that just doesn't match, or they don't even know that there are rules like, you can't take people off healthcare and pay them on the side, and you can't do off balance sheet transactions, and stuff like that people just don't know. And so oftentimes we're really just trying to make sure that we know what reality is, and really get to know these companies. I think one of the things that makes us, again, very odd in the private equity world is almost no one does due diligence in-house, at least not anymore. And this may be something that's unknown to you all or to your audience, but the easiest way to do due diligence is you hire a law firm and you hire an accounting firm and you tell them, okay, here's the company, here's the terms, make it work. And their job is to basically go through and do the diligence and get to know the company, and then tell the buyer, yes, I think that the price you're paying is good, or yes, I check off on the transaction. And it's really a CYA activity, right? I mean, they are just trying to make sure that they can pass blame off on somebody else. And look, you don't have to have the staffing to be able to do due diligence on staff. It's a lot cheaper. You have all your investors pay for those costs, all those things, right? For us, because we want to own these companies for a long time, like we want to do the work because we want to get to know the company. Like we actually want to know the people and know the operations when we close. I mean, I know it's a shocking concept, but so we do the work. We use an outside law firm to help paper the deal. But really not much beyond that. We have in-house counsel. We have a really great financial team that's deeply thoughtful about this stuff. And we've created systems over the last, we've been at it 15 years now, really 10 hard in this space. We created some systems that I think are pretty cool that allow us to keep track of information. And when we close the deal, we're saying, great, guys, we think we know how we can maybe add some value and help everyone in the situation. Maybe we're wrong, but we've got to know you all pretty well to be able to do that. Second part of your question was around how do people get to know us? Really spend time with us is the best way. I mean, I've certainly talked to other sellers, Google or whatever, listen to bad podcast episodes, whatever you want to do. But, I would say the biggest thing is just get to know us, spend time with us. That's one of the most frustrating things about some of these heavily banked deals. Intermediaries that basically want to keep you apart until you're meeting at the altar. Is the quickest way to figure out if you want to be a partner with somebody long term is to spend time with them, and the quickest way to find out you don't want to be a partner with somebody is to spend time with them. So there's a pretty heavy bias against spending time with the other party, because it might turns out that you may not like each other and then they don't get their fee. That sounds super cynical, but it's true. And so we really emphasize spending time together, eating meals together, having discussions, just learning about each other's families, learning what you like, what you don't like, really just trying to get to know each other. So that post close, you're not just calling a random person at a random place and asking them for money or asking them for help. It's a relationship, and we care deeply about the people we work with, and we want to serve them and care for them.
Sounds good to me.
So simple, but so brilliant. This is still in due diligence mindset, but a little off the beaten path. As you know, we work with a lot of entrepreneurs, and we work with a lot of people who are not. And so we often get into conversations. I suspect you hear this from time to time too, from clientele or people that we know in the community who are looking to buy private businesses, right? Or a piece of a private business. What would you say tend to be the biggest pitfalls that you see in the common practice of an individual trying to do this? And what advice, if you could give them anything, would you give to try to avoid some of those pitfalls? And you cannot say actually do due diligence. You can't say that. It's got to be more specific than that.
Yeah, well, so maybe we could start with, I think a big difference between the area of the market that we play in versus upmarket and traditional private equity. So we like businesses. Typically, they're $3 to $8 million in free cash flow. Kind of underneath us is what we call country club deals or search funds. I mean, look, there's people all over the place. You've got huge transactions being done by fundless sponsors. And you've got tiny companies, private equity firms, doing roll-ups of tiny companies. So there are exceptions to this rule, but for the most part, traditionally country club deals and search funds were in that kind of under $3 million of EBITDA range, using EBITDA just as a standard metric that everyone uses. Not because it's a great metric, but that's what everyone uses. Up market from us is kind of starts around 8, maybe 10, and goes up from there. If you have a business doing more than $10 million of free cash flow, like it's a very good chance it's a saleable asset. We've seen some non-saleable assets above that range, but usually if you're doing $10 million of free cash flow, like you're able to pay people well, you're able to attract talent, like you figured something out. And it probably, if you've been doing that level of free cash flow for 15, 20 years, there's gonna be a lot of resources to be able to help the company be structured and grow, right? In our area of the market, I would call under 10, most companies are not saleable. So the vast majority of companies are non-transferable, non-saleable assets outside of what we call owner moat, right? It's the goodwill of the owner. It's their relationships. It's their expertise. It's the way that they've, kind of got people devoted to them on staff. Everything's set up to where they're the linchpin. You pull that out and everything just falls apart. So the question is, what's the advice I have for those people? It depends on what you're trying to buy. So if you're buying something that's above 10 million, develop good relationships and put on your armor and go to work against private equity, I think is, the best advice I'd have there. If you're buying something under $10 million of free cash flow, and really when you start getting under 5, your default assumption is you shouldn't buy it. So you need to see hundreds and hundreds of deals. You need to make sure that you are really how does it feel like to sit in the owner seat? What are you worried about? Because you want to eliminate all the things you'd actually be worried about, because those aren't typically the things that are going to bite you. It's gonna be all the stuff you don't know about that actually hurts you. But we call them controlling factors. So what are the 3 to 5 controlling factors? If you get those right, you can get all other stuff wrong and be fine. But there's typically 3 to 5 things in every deal that you got to get right. I mean, if you've got a customer concentration issue, as an example, let's say a customer might be 80% of revenue, which, by the way, we've done transactions that are like that. You just got to really diligence and make sure you understand what is the customer situation. Why would they stick with you? What's the competitive situation in that? How's pricing work? How's pricing power? All those things. So every situation can be a little bit different. It's hard to say, to somebody, without a specific situation, without a specific person. I would say know your skill set. So there's a lot of people who are financial people who are drawn to the space because guess what? The yield at a 5 times multiple is a lot higher than you can get in the stock market. Like, you don't really need a spreadsheet to figure that out. So there's a lot of financial people though that are attracted to that. And look, there is, as a joke in the past, there's gold in the hills. The problem is to get it out, you need a lot more than a financial mindset and skill set. And so if you've never operated a company that's small, if you've never owned a company before that's small, and I know there's a little bit of chicken and the egg here issue, and I totally get it. You're going to get worked over, and it's going to be in ways that you just couldn't expect. And the things that you think are going to be hard are actually not as hard as you think they are. And the things that you think are super easy, you're going to be blown away at how difficult they are. So I would just say my advice is dip your toe in slowly. I talked to a family office the other day that had lost, they bought $110 million of small businesses over about a 6-year period. And the current audited value of them was under $20 million. And so, if you want to lose $100 million quickly, I think that's a pretty good place to do it. We call that a non-efficient market. I mean, right? Like the definition of efficiency is, if you tried to lose money, could you? And my goodness, you can lose, if you try to lose money in this area of the market, you can do it very, very easily. If you don't try to lose money in this area of the market, you can lose it very easily. So I would just say it's fraught with danger. This is what skills matter, right? And how you do things really matters. There's a reason why we're so strict and focused, is because if you're not disciplined, you're going to have a lot more problems than even normal.
So it's fair to say that it's not what you know that will kill you, but what you don't know.
Yeah. And you want to narrow the band of what you don't know. I mean, the things now that I look for in deals are just totally different than I would have 7 or 8 years ago. I mean, some of the same overlap, right? But there's often things that you just pick up along the way that you're like, wait, I've seen that movie before, and that doesn't end well. And so trying to pick up more and more of those.
Out of curiosity, can you just give a couple of examples of what you started with looking for red flags and how those and what some are some big ones that you look for today in comparison?
Yeah. So, I mean, a good example of this is I used to think that seller debt was the best thing ever. I mean, great. Like, you don't have to deal with a bank. Like, you get some of the benefits of leverage. You get to align interests. That's fantastic, right? Like, why would you not put seller debt on every single deal you do? Great. So now you've got it. And turns out when your CEO is your largest creditor, they run things differently than they did prior to them being the largest creditor. And so we found that, as an example, in certain situations, maybe it's still fine to have seller debt, but we've learned how to structure it very differently. And we just think that a just regular amortizing, debt structure where the CEO is the major lender probably doesn't lead to as much long-term success as you'd expect, as an example.
Very interesting. Never would have thought of that. That's I could see how that would fly though. Yeah. So I like to just wrap up my line of questions with what's happening today. So obviously the last 18 months has been very interesting. Some good, some bad. So I was curious what permanent equity has been seen in the ponds that you fish in post-COVID, well, not even post-COVID, in intra-COVID-19. And are you seeing buying opportunities, or are prices elevated, or are they super low? Are assets on fire sales? Like, is there a barbell going on where there's a lot for sale and then there's a lot that aren't for sale that are trading at high prices? Can you go into that a little bit?
Yeah, that's a good question. The market is weird, is how I describe it right now. If you've got a really good business and things macroeconomically are not doing great, you're not going to sell it. Just period. Like, no one says, you know what? There's a huge storm on the horizon. We're in the middle of it. The wind is blowing. You know what we want to do is create an incredibly laborious sale process that's going to be stressful for everyone. That's just not what you're going to do. So in the depths of COVID, and really for the most part in 2020 in general, the only assets that were for sale were some sort of forced seller. And we saw some really sad situations. Family business has been around for 80, 90, 100 years that were on the brink or going under. It's really sad. It was tough. There was a period of time, I mean, not only in our existing portfolio where it was hectic and challenging. I mean, obviously we have great balance sheets and lots of redundancy, and all of our companies got through it. And by the way, I think that 2020 for our model really reinforced why we do the things we do the way we do them. We got a lot of crap for not using debt as an example in the private equity world, and we sailed through and actually were able to consolidate a lot of opportunities in 2020 as a result of that. When everyone else was having to lay people off and sell things, we were the ones hiring and buying. So, separate from that, there really is right now a bifurcation in the marketplace in terms of the prices that people are willing to pay for something. If you're able to buy something that's fairly what I would call standardized, meaning there's one of you in every city and you can kind of roll them all up and squish them together and make a big organization out of them, people are willing to pay a lot more because that's going to attract traditional private equity, and they're coming down market in that way. So this is HVAC and plumbing and lawn care and pest control. I'm just using all the home and office service space, but it's a good example of stuff that's going on. I mean, those a $2 million HVAC service company right now, we've seen trade at, 9 times, 10 times. You take that same earnings stream, and actually I would even argue an even more durable earnings stream just from a business model that's non-standard or from an industry that can't be standardized, and you're going to pay half that, if not less. So it really is a matter of can you take the thing, squish it together with a bunch of other stuff and make it a big thing, and then arb on the way up is what they're trying to do, right? So you buy it 10 times, you sell it 20 times, you go public or whatever the thing might be. Outside of that, there's really not been too much inflation. I mean, you're going to have what I would call the one-off weird billionaire's son or daughter issue in this area of the market. So we've got, we got outbid the other day by 3 times, I think, literally 300% difference between our purchase price and somebody else's, because it was the first thing that this billionaire's kid was buying. That can kind of be annoying, to be honest. But good for the seller. We told them, hey, Godspeed, and that's awesome, and good for you, and go cash that check as soon as you can. So you're just going to have weird one-off type things that happen like that. So the market is certainly not efficient in that way either.
That billionaire's kid one really made me laugh. That's a good one.
It's true. We've seen it.
So with that, I think it's time to move to closing remarks. So for me, I'd have to say that I really appreciate how Permanent Equity and the sellers have both found a buyer and a seller, a partner to work well together within a framework that works best for all parties. There is, I think, something to be said for not necessarily meeting in the middle, but finding a structure, finding a method that works for all party. And it's along the lines of a compromise is how I would phrase it. I also really appreciate the sentiment of, paraphrasing here, what you don't know will kill you. And I try to live by that phrase as well. And I think that it should be, the concept should be used more widely than it is. One should stick to their niche and grow from there, because speaking for ourselves, we found that there are plenty of places to grow within our niche that have yet to be explored. So it's just all about somebody finding their niche and sticking with it. That's the definition of a fantastic investment in many different ways. Dan?
Yeah, thank you, Nathaniel. Brent, you had a lot of great things. I've been writing them down. And so I just, as highlights, I just want to mention a couple of just the statements that resonated with me. You can't make good long-term decisions with short-term capital. Yep. When you phrase it like that, it makes perfect sense. One thing we didn't really talk about, you said early on, is that it's good not to be a forced seller. And that all goes down to positioning. We spend a lot of time on that with individuals, looking at those individuals as a household business, and how important it is to position yourself so that you're not a forced seller. I enjoyed a movie, I haven't seen it for years, called The Thomas Crown Affair. There's 2 versions of it, and there's a scene in The Thomas Crown Affair early on in the second version where they're doing a deal, and the guy says, "I never thought I'd see the day that that Thomas Crown was forced to sell something." And then before leaving the room, he said he told them what they actually paid and what others were willing to pay, and wished him good luck explaining that to his board. So it's really important to understand when you're dealing in a forced situation and to try to keep out of that situation. So I thought that was really astute. And perhaps we talk about that again some other time. I liked, because I think this could be applied to life a lot too, when we were talking about terms, that you choose the hills that you want to die on. Very true in every aspect of life. My brother and I were talking about that in relationships and marriages and stuff the other day. Also true here too, right? Because this is about relationships, and you spoke a lot about that. The focus on relationships, getting to know one another before you enter into business or continue to. It's important, Nathaniel touched on this too, to know your skill set and to also try to narrow the band of what you don't know. right? Those are actually cousins of one another. And I really, of course, like, just try to treat people well. It's very easy. It's not hard to do. It goes a long way, and people appreciate that, because a lot of times it's not done, so they appreciate it more. And the last piece I'll mention is, you do what makes sense for the companies you serve, and sometimes that makes that road a little longer than what some people might be comfortable with, but it's a much better road. And akin to the philosophy of just treating people well, that comes back tenfold, typically speaking. So I want to thank you for all those tidbits of wisdom and much more that you provided today. And with that, I will pass the baton to you, Brent, to leave us with your final thoughts.
I don't think I have anything profound to add. I really appreciate you guys having me on, and I appreciate the conversation. And if I can be helpful to you or to your listeners, never hesitate to reach out. I'm available. So I just really appreciate it. Thank you, guys.
No, thank you. And it was great to see your smile the entire time, Nathaniel.
It's a rare thing to see, I know. So once again, thank you, Brent, for coming on here with us. Really appreciate it. Brent can be found on Twitter, and his company is Permanent Equity. Not only do they buy and sell companies for the long haul, they also have a couple of other things on their website that you can look into. They have Orbit, which is a network for other professionals that they have used to, correct me if I'm wrong here, Brent, but they've used to help build out not only the companies that they have bought, but to also connect other professionals finding other jobs. And then they also have something called the Scout Network, which is a network that they've created to help them source other deals, new deals. So if you're at all interested, I encourage you to go to their website, permanentequity.com, to give it a look. There's also a huge number of resources on there. Highly encourage you to read it and check it out. So with that, thank you and have a good day.
Thanks, guys. Have a good one.
Thank you to our audience for, of course, joining us as always. We appreciate you being here. Until next time.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,